Hi everyone, I am Ranjitha, Assistant Professor, Department of MBA, Sai Vidya Institute of Technology, Rajankonde, Bangalore. Subject Direct Taxation, third semester, Module 4 Income from Capital Gains. Let us see what and all the topics included in Module 4. Income under capital gains, basis of charge, transfer of capital assets, inclusions and exclusions from capital gains, computation of capital gains, deductions from capital gains, income from other sources, only the theory part, and problems on computations of capital gain. These are the topics which are included in the module 4. Next, capital gain. It includes section 45 to 55A. Let us understand what does the meaning of capital gain means. Any profit or gain which is arising from a transfer or the sale of capital assets is known as capital gain. If you are earning any profit or an income from the transfer of a or a sale of a capital asset, such profit or gain is known as capital gain. And the capital gain shall be charged to tax in the year in which the transfer of the capital assets takes place. Next, one, an asset is inherited. So, if the asset is inherited, in such a case, you are not supposed to pay any tax. But if you sold that asset and you are getting any income from that, or you are getting any gain from that, in such a case, you have to pay a tax to the government. Here, there are some of the conditions in order to include the income under head income from capital gain. Let us see what and all the conditions. There must be a capital gain. First condition says there must be a capital gain, and the second one is the transfer must be a capital asset. Next, third one is the transfer must have been taken place during the previous year, and the fourth one is the transfer of such assets must give rise to the profit or gain. If there is any loss, then you are not going to include under the head income from capital gain. Only when there is a gain, and that gain must be taken place during the previous year, and that gain must be from the transfer of the capital asset. Okay. Let us move on to the next topic, that is transfer. Under section 2 subsection 47, transfer includes a sales, exchanges or relinquishment of the assets or extinguishment if any right or the compulsory acquisition under the law or conversion of the assets into stock in trade. So these are all included in the section 2 subsection 47 of transfer. Following are not considered as a transfer under section 49 subsection 1. Let us see what and all the assets which are not considered as a transfer. The first one is the transfer of asset in case of scheme of amalgamation. Second one, transfer of agricultural land before 1/4/1970, and the transfer of debenture or bonds into shares. And if there is any transfer of assets in kind at the time of liquidation, and transfer of assets by the parent company to its own subsidiary company, and the transfer of assets under the gift or will, transfer of assets at the time of partitions of HUF. In such cases, these transfers are not considered as a transfer. Next, let us move on to the meaning of capital gain. Under section 2, subsection 14, capital gain means any property of any kind held by the assessee, whether connected or not with the business or profession. It may be any kind, student. It may be a movable property, or it may be immovable property, tangible one or intangible one. Okay, any type of property he has to be held it, and whether it is connected to business or not, but it is called as a capital gain. For example, land, building, house property, vehicles, patent, trademarks, leasehold rights, machinery, jewelry, shares, debentures. These are all the things we are going to call it as a capital. Let us see what and all are not considered as a capital assets. What are the exceptions? The first one is trade in stock. If there is any raw materials or a consumable goods, such goods or stocks are not considered as a capital asset. Second one is personal goods. If there is any personal goods, for example, car, scooter, TV, refrigerator, such goods are also not considered as a capital assets. Next, 6% of gold bonds 1977 or 7% gold bonds 1980, national defense gold bonds 1980 issued by the central government. Any of these bonds which has been issued by the central government, such assets are also not considered as a capital assets. Next, special bearer bonds, gold deposit bonds issued under the gold deposit scheme 1999, agricultural land in rural area in India are also not considered as a capital assets. There is a definition, students. In order to consider a land as agricultural land, it has to fulfill certain conditions. Let us see what is that. From the assessment year 2014-15, any area which is within the jurisdictions of a municipality is known as agricultural land. Okay, if it is coming under the jurisdictions of a municipality, then it is called as a agricultural land having a population of less than 10,000. There must be a population of 10,000, less than 10,000. Okay. Next, if it is situated outside the limit, if it is within the limit, then the population limit is 10,000. If it is more than 6 kilometers from the local limits of any municipality, if it is a 2 kilometers, then the population limit is 10 lakh, 10,000 to 1 lakh. Okay. If it is 6 kilometers from the local limit of any municipality, then the population limit is 1 lakh to 10 lakh. If it is 8 kilometers from the local limit of any municipality, then the population should will be more than 10 lakh. In all these cases, we call this area as a agricultural land. Okay. Next, it has to fulfill all these conditions or any one of these conditions in order to become a agricultural land in rural area. Next, types of capital assets. Mainly, we have two types of capital asset, that is short term and long term capital assets. Short term and long term, these are divided only on the basis of the period of holding of assets from the date of purchase to the date of sales of a capital assets by the SSC. Okay, based on the holding period of the asset from the date of purchase to the date of sales, we are going to consider it. Financial assets, other assets. Financial assets, it is held for less than 12 months or 1 year, like securities, bonds, shares, mutual funds. If it is hold more than 1 year or 12 months, then they are called long-term assets. If they are hold for less than 1 year, then they are called as short-term capital assets. Next, go for the other assets. In other assets, we have two types of assets, that is movable properties and immovable properties. In case of movable properties, if you are holding that assets less than 36 months or 3 years, such assets are known as short term assets. If you are holding such assets for more than 36 months or 3 years, then such assets are known as long term assets. Next, in case of immovable property, for example, it may be a land, building, house property. In such a case, if you are holding the immovable property for less than 24 months or 12 months, then it is called a short term assets. If you are holding that asset for more than 12 months or 24 months, then they are called as long term assets. Next, these are the two types of assets we can come across. Again, there is a capital gain. The capital gain can be divided into mainly two types, that is short term capital gain and the long term capital gain. Short term capital gain means, students, any gain arising from the transfer of short term assets, then such gain is known as short-term capital gain. For example, equity funds are considered short-term when held for less than 12 months or 1 year. Okay. Next, what about the tax treatment? Tax on short-term capital gain when security transaction is not applicable. If the security transaction is not applicable, then what you have to do here is the short-term capital gain is added to the income tax returns and the taxpayer is taxed according to that income tax slab. So if the the security transaction tax is not applicable, then what you have to do here is the short-term capital gain is to be added to the income tax returns and then you have to pay a tax according to the income tax slab. Okay. If the security transactions is applicable, okay, in such a case, the short-term capital gain is taxable at a 15%, and again you have to pay a surcharges, and the health and education cess is also to be included. Okay, next go for the long-term capital gain. Long-term capital gain means any gain arising from the transfer of a long-term capital asset is known as long-term capital gain. For example, house property held for more than 3 years is termed as a long-term capital asset. Next, the sale of equity shares. If there is any sale of equity shares and if you are incurring income exceeding 1 lakh rupees, then 10% of tax has to be charged. Okay. In other cases, we are going to charge 20% on the capital gains. Next, let us understand what are the terminologies which are used in income from capital gains. The first one is full value consideration or sales consideration. Sales considerations means the consideration received or to be received by the seller in exchange of his asset. For the exchange of the asset, what he is receiving or what he may receive, such consideration is known as sales consideration. The capital gain are chargeable to tax in the year of transfer. In which year the transfer has taken place, on that year the tax has to be charged. Next, cost of acquisition. Cost of acquisition means the value for which the capital asset was acquired by the seller. Next, cost of improvement. Cost of improvement means the expenses incurred to make improvement to the capital assets by the seller. For example, it may be an alteration or repairs, etc. Okay, and if there is any improvement, cost of improvement made before April 1st, 2001, then we are not going to consider that cost of improvement. If it is after 2001, April 1st, 2001, then only we have to consider it for our calculation purpose. Next, selling realization expenditure in connections with the such transfer. You know that when we are transferring some of the assets to other persons, we may incur some of the expenses. It may be a brokerage, it may be a commission, it may be a cost of stamp, paper, registration fees, traveling expenses, legal expenses. Okay, such expenses are known as selling expenses. Next, here there is a format to calculate the capital gain from long-term assets. If you know this format, it is easy for you to compute the long-term capital gain. Yes, particulars and two amount columns. The first thing what we have to take is sale consideration. Take a sale consideration value at the first and take amount to the outer column. From that deduct the selling expenses. If you have incurred any selling expenses related to the transfer of the capital assets, please include here. Okay. Yes, after deducting selling expenses, you're going to get net sale consideration. The first thing is we have to take a sale consideration. From that, deduct selling expenses. After deducting the selling expenses, you're going to get net sale consideration. From that, we have to deduct indexed cost of acquisition. Okay. Next, again we have to deduct indexed cost of improvement. After deducting these two, we are going to get a long-term capital gain. From that, we have to deduct if there is any exemptions under section 54, 54B, 54D, 54EC, 54F, 54G, 54GA. If there is any deductions under section these, you have to deduct it, and the balancing figure what you are getting, that is known as taxable long-term capital gain. Next, let us move on to the computation of short-term capital gain. What is the format to calculate the short-term capital gains? Here, students, the format will be same. The format will be same. The one thing, the changes you can see here is only the indexation. Here, in long-term capital gain, we are doing the indexed cost of acquisition and indexed cost of improvement. Is it right? But in short-term capital gain, we are not going to make any indexation. Directly, the amount is taken for our calculation purpose. See the format? Particulars and two amount column. This for the first value we have to take here is sales consideration. Take that amount to the outer column. From that deduct the selling expenses. After deducting the selling expenses, you're going to get a net sale considerations. From net sale considerations, we have to deduct the cost of acquisition and the cost of improvement. We should not do the indexation here. Next, after that, you're going to get a short-term capital gain. Short-term capital gain. From that, again, we have to deduct if there is any exemptions under sections 54 to 54 GA, then deduct it. After that, what is the balancing figure you are getting? That amount is known as taxable short-term capital gain. This is the format about the short-term capital gain. Let us move on to the next one. Calculations of capital gain for depreciable assets. If there is any depreciable assets, then what is the format to calculate the capital gain? Let us see that. Again here, particulars and two amount column. The first thing we have to consider is sale consideration. There is no changes. Same format is going on here. Sales considerations, take that amount to the outer column. From that, deduct the selling expenses. Yes, after deducting the selling expenses, you're going to get a net sale consideration. From here onwards, the format is going to be changed. See here, in previous cases, we were used to deduct the cost of acquisition, cost of improvement, or the indexed cost of acquisition or indexed cost of improvement. But in case of depreciable assets, here we are going to deduct a written down value. What? Written down value as on 1/4/2020. We have to deduct it, and less cost of new asset purchase during the year. If you have purchased any new assets in the previous year, please deduct it. Okay. Yes, I'm repeating from the net sale consideration, what and all the things we have to deduct. The first one is written down value as on 1/4/2020, and the second one is the cost of new asset purchase during the previous year. The both the amount has to be deducted. Okay, next, after deducting, what is the balancing you're getting? That is known as taxable capital gain. And one more, the one important thing you want to remember here is when there is a written down value. Okay, if you're finding any written down value in the question, okay, in such cases, what is the capital gain you're getting? What is the capital gain you're getting? That capital gain is known as short term capital gain. Okay, if you're finding any written down value in the question, then what the answer you're getting is it will be always short term capital gain only. It never ever becomes a long term capital gain. Okay, next, calculations of capital gain for self generated assets. If there is any self generated assets, here we have a formula to calculate capital gain. Okay, same particulars and two amount column. First, we have to take a sales considerations. From that, deduct any selling expenses are there. Then the net sale considerations, what you are getting, that will be a capital gain, students. Because for the self-generated assets, there is no cost of acquisition. For example, here you can see that for the goodwill, the cost of acquisition is nil. Okay, next, as the cost of acquisitions is nil, the further calculations is not there. Next, go for the cost of acquisitions. Okay, how to calculate the cost of acquisition? See here, students, if the asset is acquired before 1/4/2001, if it is acquired before 1/4/2001, then we have to compare the two costs. That is, actual cost must be compared with the fair market value. In this, which is the highest one, that is considered for as the cost of acquisition. Next, if the asset is acquired after 1/4/2001, okay, if the asset is acquired after 1/4/2001, then there is no question of fair market value, only the actual cost is considered. Okay, I'm repeating. If the asset is acquired before 1/4/2001, we have to compare the two costs, that is actual cost and the fair market value. In this, which is the highest one, that highest amount is known as cost of acquisition. Okay, if you are purchasing or if you are acquiring an asset after 1/4/2001, then only the actual cost is considered as a cost of acquisition. Next, indexed cost of acquisition or improvement. What is the meaning of indexed cost of acquisition? See here, students, indexed cost of acquisition is also known as cost inflation index. What? Cost inflation index. It means influencing the cost of an asset acquired to the present value. You know, we purchased in 1993. Okay, you have to increase the value of the expenses to the present. Okay, indexation benefits are available only to the long term capital assets. You know that you have seen in the format. Okay, only for the long term capital gain we have made the indexation, and for the short term capital gain we have taken the actual amount what is there, cost of acquisition and the cost of improvement. Okay, means you can see, you can understand that the indexation benefits are available only for the long term capital assets. However, the indexation benefits is not available in case of debentures, even though it is a long-term capital gain. There is an exception, students. There is an exception. Even though the debenture is a long-term capital asset, debenture is an exception. We are not able to make an indexation for the debenture. Next, how to calculate the indexed cost of acquisition. Here is a formula to calculate the indexed cost of acquisition. The first one is if the assessee acquired the property before 1/4/2004. See here, students, if the assessee is acquiring a property before 1/4/2001, then we have to, in order to calculate the indexed cost of acquisitions, we have a formula, that is actual cost or the fair market value. In this, whichever is higher is considered as the cost of acquisitions, you know that, and multiplied by CII of the year in which the asset is sold divided by 100. This is the formula to calculate the indexed cost of acquisition if the asset is purchased before 2001. If the asset is acquired after 2001 for 2001, we have a different format. What is that? Index cost of acquisition is equal to actual cost, that is nothing but cost of acquisition. We are not going to compare with the fair market because it is acquired after 1/4/2001, divided by cost of inflation index, that is CII, the year in which asset is acquired. In which year the asset is acquired, that year CII should be taken here, multiplied by CII of the year in which the asset is sold. So denominator in which the asset is acquired, and here in the numerator in which year the asset is sold. Okay, next. This is the two formulas to calculate the indexed cost of acquisition. Let us move on to the indexed cost of improvement. The year in which the improvement took place and the cost inflation index for the year in which the asset is transferred. For short-term capital assets, the actual cost of improvement is allowed as a deductions, where in case of long-term capital gain, it will be indexed as and allowed as deductions. So I have told you earlier on the students, only for the long-term capital gain only, capital assets only, this indexation is applicable. Okay. Here also, if the asset is purchased before 1/4/2001, we have a separate format. If the asset is acquired after 1/4/2001, we have a separate format. The first one is if the improvement incurred before 1/4/2000, it should be ignored. Okay, if there is any improvement before 1/4/2001, please ignore it. And if there is any improvement after 1/4/2001, please follow this format. Cost of improvement divided by CII, the year in which the improvement is made, multiplied by CII, the year in which the asset is sold. This is the formula to calculate the indexed cost of improvement. This is enough for today's class, students. We are going to continue the classes in the next session. Thank you. Have a nice day.